So, good morning, friends, and welcome to this episode of Cafe Mutual webinar. Friends, we have seen many changes last year. I would not list them because there are too many. So now it is the time. Now the time has come to look back and move forward. Friends, how 2021 would be for the MF industry? Will it be good for mutual fund distributors and fund houses? To spill the beans, we have with us Swarup Mohanty, CEO, Mirae Asset Mutual Fund. Swarup has over 20 years of experience in the MF industry, and he has played key role in expanding footprint of his fund house across the country. Welcome, Swarup.
Thank you, Nishan. Thank you so much for having me. First of all, congratulations, Cafe Mutual, for 10 years. Phenomenal
Thank
job and keep it going. Yeah.
Great. Thank you. Thank you for your kind wishes. So, Swarup, I would start my interview from the question which is on everyone's mind. So, we have seen many changes this year due to COVID-19 pandemic. So, Swarup, what changes according to you are here to stay?
See, I think, Nishant, all of us have to still wonder that, we're still in a pandemic and it's not ending. And a broad part of that pandemic we spent in sitting at home. And when you sit at home for an extended period, lot goes on the mind. I think the first thing that has changed permanently is the health status. Health used to be a priority only in the subconscious, but now I think health will be practiced by everybody. This care has given the rightful, push to all of us to put health first. And I think the second most important, which has changed permanently, is the money part. Let's face it, we used to spend money in a certain way, but it's been 7, 8, 9 months of differentiating between the needs and the wants. And then even if we want, we cannot spend much in the want career. And in spite of not spending in the want career, our life is going on well. So I would feel that the expense statement of every individual is permanently changed. I think people going forward will look at deploying the same money a little judiciously and thinking twice on the one side. And that's a COVID sort of impact, which I think is permanent. The other thing which people talk about is digitization. I think digitization is given and it's part of our life. If you are buying vegetables online, then we should be buying financial assets online also. And it's just an extension. I think COVID has given that impetus to digitization, but anyway, it was on the way. This sort of triggered it, is what I can say. And the last part, I carry a little, philosophical view on work from home, which is now a reality. I'm not a big fan of work from home. I'm a very physical meeting kind of a person. And I just hope and pray that we look at this concept of work from home a little more deeply, because it comes with a huge danger of social isolation. And especially in a country like India, which is so social in nature, one has to look at it very deeply before implementing it permanently, is my submission from a COVID perspective.
So, Swarup, so what would be the impact of pandemic on fund houses and distributors in the coming years?
See, I think both fund houses and distributors have seen different crises over the years. I mean, this is not the first one. This is probably the first nationwide health crisis. Each crisis comes with its own learnings, and then COVID too has had its share of learnings to all of us. The COVID impact, is already there when it comes to increasing efficiencies, both in terms of man hours as well as in costs. That's something which cannot be ignored. And I think one of the biggest benefits of COVID has been the increasing efficiencies on both these sides. I think the way we communicate has been permanently altered, and the means of communication has become so broad. And that's thanks to COVID. And that's something which has helped us talk to each other in a far broader sort of mediums than we did earlier. And that's something which will remain permanently. Going forward, physical meetings will be premium and should be treated as premium. And the reason why you meet physically should be well thought of before those meetings happen, not that meetings should not happen. But finally, from business perspective, we are a business of wealth creation. And fund houses who have kept their products intact and will intend to keep their products intact will benefit in the coming times, and distributors who have given their investors a good investment experience will benefit immensely when it comes to times to come. it is a simple business, and the more simple you keep it, the better it remains and more sustainable it becomes.
So, Swarup, you have talked about change in means of communication. Many people are now preferring digital channel to communicate. But for distributor, what would you recommend? Is it physical? Should they go with physical meeting, or should they continue with digital meeting?
Like I said, the physical meeting has to be with a cause and a premium. When you do the physical
Mm.
meeting, it cannot be just for what is the market view. Those kind of meetings can be
Mm.
done digitally, but when it comes to portfolio review and when it comes to portfolio
Mm.
rebalancing or recommendation of a new products,
Mm.
if it is not part of the existing allocation and it needs a little bit of deeper understanding, those should be physical. But normal business as usual can become digital. That's for us and the distribution community also. When we interact, if we have to give a market view, we might as well do it digitally. But tomorrow, if
Mm.
says there is a certain view I have to give on a certain product, then
Mm.
I should do a physical meeting, and that has to be a evolved meeting rather than just a market view
Mm.
meeting, is my opinion.
Okay. So, Swarup, which segment of distributors have been most affected due to pandemic, and which section have been benefited?
See, I think initially, it still is a very closed and digital environment. So distributors, and this I suspect, I cannot say with a lot of surety, people who were totally dependent on physical transactions or mode of transacting would have been affected in the initial days. I'm sure they would have found a way out. But who has benefited is not exactly restricted to COVID or any crisis, but would be more about the business plan or the business model that one runs, and that's true for both fund houses as well as for distributors. Sustainable business models are those who are equipped to take such shocks, and absorb such emergencies. And in our business, it is all about asset allocation and good product performance. I mean, the way the markets and the underlying environment has evolved during this period, it has thrown up a great chance for people who were, or people who were skewed to certain allocations. They would have not benefited at these times. I'd like to give you our own example. Let's look at us. We are what, 85% of our assets are in equity. And while there is so
Mm.
much talk about equity, let's face it, this has probably been one of the best years for debt investing for a long time now. And then it's not that we didn't have debt plans, but COVID suddenly happened and the environment changed, the interest rates changed, and that benefit which a fund house which has far broader products with a bigger track record would have benefited far more than us. Though the fact still remains that our portfolios are free from credit, and we can go about giving our basic spiel on how our products are good. But fact is, we didn't have products in those buckets to become more sustainable in these times, and that's something which one has to watch out for. And no longer are there times when you can survive with just allocations to certain asset classes. The rules of asset classes are changing. The effect of asset classes and their performances are changing. So a rightly built asset allocation model spread across different asset classes will be able to absorb such shocks going forward. Not that COVID will be the first and last. There could be many going forward. So that's something which I would like to point out as something which then makes the business solid and sustainable. And those are the people who would have had assets on both sides, who would have benefited more than say a fund house like us.
Okay. Swarup, 2020 has been one of the good year for your fund house. In fact, Mirae Asset MF is one of the fastest growing fund house in terms of growth in assets last year. So, what are the three things that has contributed to this growth?
See, difficult to point out three things, but what I'd like to point out is the asset growth is an outcome. One, I don't think can really plan asset growth in our business. The more important thing is the product. And I think that's where we've believed in a certain type of a business, and we firmly believe that it is a business of simplicity and continuity. So that's the first point. We keep our business very simple. The second point is, we build products to our strength. If there are certain categories where we believe we don't have strength or we don't take fancy to that category, irrespective of how large the asset growing capacity in that category is, we will not venture into it. There are enough examples, and even if I ask you, you can only give us 2-3 examples of where we don't feature, and we have no plans of featuring going forward too. The other part which I think has happened is, I think we acknowledge the credit risk element of the market fairly early, and we've kept our portfolios clean so far, and that's been recognized last year. So when you look at the asset growth last year, I think the equity products standing there well in the market on performance. Secondly, the debt products, all the debt funds having no credit issue. And then thirdly, I think our large SIP book has led us to a good year in such an environment. Our entire effort has been to give our partners a good investment experience, and I'm so happy, and I'll remain perpetually thankful for the way they have reciprocated to us, especially during such times.
Great. So Swarup, benchmark indices, Nifty and Sensex have touched new highs despite macroeconomic concerns. So, what are the key reasons for this?
I think it started with the inflow. Finally, in the short run, stock market is like any other market. It's very supply demand driven. In the short run, we saw a lot of money from FIs coming in. One of the reasons was the definite increase in the MSCI index, which got money to India. Now, in that period, DIs were selling, especially I can speak for mutual funds. We were selling not because we wanted to create some cash or anything. Fact is, we got redemption, so we sold. And that's the reality of the market as we speak from a mutual fund perspective. But fact is, there was good inflows from FIs when it comes to India or the Indian markets. And then when you look at the liquidity position of India and Indian markets not being that liquid, it does not need a lot of money to sort of ramp up the market. And that's how the markets are positioned. I think when you look at the FI inflows, apart from the MSCI index, what's worked for India, and that's what we get a sense when we talk to our global offices, is that definitely that India, keeping, I think the oil prices have helped us a lot, that it being stable throughout this entire thing has helped India tremendously. And that was a view which I think pre-COVID, a lot of people were carrying, and that played out. Our foreign reserves have become stronger, and that's something which every investor sort of looks at before entering the country. And then the third more important thing is the currency has remained stable. So when you look at these 4-5 factors, it's led to some money coming into India, and it's been good for the market so far. The good part is, we've seen some broad basing of the market, and that has been, I think, more important than just, the kind of a very polarized market that we were seeing prior to COVID that was emerging.
So, Swarup, what about valuation? Is it attractive enough?
See, I think valuation is a very interesting part, and I've followed this story throughout my career as a fund seller. When money comes in, these things don't take I think it does not take center stage. At this moment, we are in a good sort of wicket when it comes to inflows. And then it's not that the entire market is rallying, let's face it. Some good stocks are found. See, let's go back pre-COVID. When you look at the pre-COVID scenario, we were in a very polarized market. And then this was our view then, is that in that market, it was a fund manager's paradise because the rest of the market was wide open. I think that is what has happened a bit in this time. Lot of scope still to go, but some good stocks have found good money chasing them, and hence this market has been more broad-based than what it was pre-COVID.
Okay. So talking about inflows, so equity funds have been witnessing outflows for the 5th consecutive month now. Yeah. And SIP inflows are also slowing down.
Correct.
So what are the key reasons for this, and when can we expect this trend to reverse?
Okay, first things, let's go a little back in the story. The Indian investor and the Indian mutual fund distributors have been consistently buying equity for the last 5-6 years, if I remember correct. We've been, almost 48-50 months net sales positive pre-COVID. Yeah, and the more important factor which I feel is that when the markets crashed, that is in the month of March and April, at the rock bottom, the industry was net sales positive. And that's if I were to give my view and when investors should buy and when investors should sell, that is the time when investors should have bought, and they did buy. We can always debate on the quantum they should have bought, but that's a separate story. The fact remains that when the markets were at bottom, people did buy. And then look at the environment, and when you look at a COVID-like situation, it acts as a natural COVID riskometer for all of us. And some of us would have not agreed with the volatility that one saw in this period, and each to his own, and each one's risk-taking profile is correct. Let me reaffirm that. If somebody is not okay with the volatility, then somebody should leave. And from our data, I can say for a fact that people who have redeemed in the last 2-3 months have gone out making money. And for a fund house, there cannot be a bigger certificate than an investor going out making money. And that's the way. Like I said, asset gathering is an outcome. Maybe next time when they look at coming back, if they've made good money with us, they would prefer us. Is a thought which is not exactly wrong. And now, from how long it will continue, I suspect it will continue for some time till we don't get some good, solid data about post-COVID impact. And then we could see some time of net outflows. Is not exactly a fear or anything, it's an observation.
What about SIP numbers? Will it go up?
See, I think this is a very interesting question, Nishant, and that's something which I'd like to point out. The SIP investor and the lump sum investor have no correlation in behavior. At this moment, when you look at the impact of COVID on people, and let's take out the people who have been affected in the cash flows. Okay, they will behave in a certain manner, which is absolutely correct. And let's take them out. The rest, if you see, the SIP book has not corrected as much as, say, it had corrected in 2008, 2009. Right? So I think if you look at rational behavior, and people through SIPs have caught the entire Jacob of the market, right? So the SIP investors have behaved very rationally, and they have stood today to benefit immensely in this short period too. I mean, I was a big person who was against this pause facility of SIPs, because when we were pushing for a pause was exactly the time when we should have been invested in SIPs. I did a Facebook Live on that too, because I was feeling very strongly about it. And I even then I had mentioned that, people who are having cash flow issues, those are separate, but people who are taking a market call should either redeem and leave the market, but should not be pausing it at a time when you will see the benefits of rupee cost averaging playing out in the SIP form of investing. But that part of the investors I feel have behaved very rationally. I will not comment on the lump sum part, because each to his own, and if they feel this is the right time to exit, so be it. But the SIP investor, I feel, has stayed invested and would have already been seeing the benefit of the sharp comeback on the market.
So Swarup, talking about performance, so many active funds have been struggling to beat the benchmark indices. So in such a scenario, how do you foresee the role of active fund management in India?
See, I think this is a fantastic time, and it's a great question. Nishant, I thank you for asking me this question, because it's a great time in India, and it's unique to India, because when you look at Mirae Asset working in 16 countries, and I say that out of our own experience, what I'm going to say now is only happening in India. Rest of the globe is working very differently. If you talk to, say, our CIO, Mr. Nilesh Surana, he will tell you that the markets are still inefficient, and there is enough scope for them to go out and create alpha, right? But you cross over and talk to our ETF team, they will tell you that markets are gradually becoming efficient, and that's the data you're referring to, the amount of underperformance to the benchmark, which is obviously there in front of us to see. And you ask that to the ETF team, they will tell you that markets are becoming efficient, hence the scope of alpha generation is narrowing. And hence one should not get into this attempt of beating the benchmark, or in that process underperforming the benchmark, but just buy the benchmark. What I feel is both sides are true, and it's at this moment, I do not know for how long, but at this moment, one can take advantage of both sides. Gone are those days when it was active versus passive. People who believe that a fund house, when a fund house starts a passive business, it has the cost of the active business. That is not true anymore. And people who believe that they have to shift completely from active to a passive, that is also true, not true anymore. Together, I think there are very good benefits that one can benefit both from a portfolio shaping perspective, because some of the stories that will unfold on the passive side, or the funds that will unfold on the passive side, will not be available on the active side. So a combination can be very complementary. For a fund house like us, existing on both sides comes naturally. This is what we've done globally. And then we start that journey in a very business focused manner from 2021. And we feel both sides can do justice together, and our job is to create good products. It is up to the partners to choose which is the right product for their investor, and that's, we will restrict ourselves to our role, and then we leave the selection of products to the partners. So at this moment, I feel it's great times for asset management and advising in India, because the number of ideas that one will see because of the passive side opening up will be far larger than what is there on the active side.
Okay. So many experts feel that Sebi recategorization has impacted fund performance. So what is your take on this?
See, I don't entirely agree with that. What it has done is it has made us true to the label, and we are comparable to each other. Earlier, when you look at the fund classification, everything was left to the interpretation of the respective fund houses. What was mid cap for us was not mid cap for somebody else, right? And how we shaped a multi cap fund or a flexi cap fund was very different to each fund house. But today that sanity has prevailed. Yes, I do believe that the TRI index has had an impact on fund performance more than categorization. Now, since it is apple to apple comparison, I feel it is healthier, and that's our opinion as a fund house. And within that, the skills to generate alpha have changed. I think that is where is the trick. One has to look at this environment or the underlying categorization and develop skills to create alpha. And I would not give SEBI categorization much importance when it comes to decrease in performance.
Okay. So Swarup, year 2020 has witnessed a sea change in MFD business. So now MFDs cannot offer services like financial planning and cannot even call themselves IFA. So in such a scenario, how can MFDs add value to their services?
Fundamentally, I believe, Nishant, this is a business of advice. And I have never agreed with the fact that you can run a business of catering to the investor without providing advice. I do believe that there is more to the story, and the story will unfold. And we've also discussed it at many forums. Going forward, and the good part of the regulatory regime at this moment is there can be dialogue, and there is consistent dialogue. So I do believe the MFDs are also in dialogue with the regulators as well as the asset management companies. I don't think this is the final shape, and I do believe going forward there will be some scope of advice, or there will be a rule laid down for advice within the MFD space. Otherwise, I mean, what you are saying is correct. I mean, how does it function? I would like to know the discussion that happens between the MFD and the investor. But I have a very simple view to this business. Going forward, when you look at COVID, and COVID has changed everybody's life, especially from the financial expense statement of everybody's life. Earlier, the amount of money that was being spent on the want side, as I said earlier, stands to change. This is the time when a good MFD can enter any investor's life and restructure his financial statement perpetually. It's that scope that is there for us. I firmly believe that COVID-19 is the trigger for financial advising or total portfolio advising to trigger from here on. So a person who now shifts focus of advice to a total portfolio-based advice and shift to a goal-based advice will take the cake from here. Please remember, for the investor, the star in his investment or her investment life is the goal. And the person who takes him or her to that goal is the rock star, right? And the rock star is the MFD in place. So though this is a little bit of restriction, but if one shifts the overall business to a goal-based model, is not just inculcating mutual funds could be a part of that, but when you look at the total asset allocation of an individual, there is huge scope for work. And let's face it, when you look at COVID or what's happened across the country, the demography of investors is changing dramatically. The number of new investors that are coming in is phenomenally high. One, the surpluses are more. Number two, the number of investors being added are also increasing, making the pie larger. So I feel this is a perfect time to build a good business model, a good asset allocated model for an MFD, and I can see a bright future going forward. And I do expect that the regulations on this will change. This is my personal opinion, because there is enough discussion. If you see the first cut of the regulation and the second cut of the regulation, there were changes. And as the practicability of this business unfolds, I'm sure the regulator will also come out and make certain changes.
Okay. So what are the three things that MFDs should do to become future ready?
I think, see, when every business is built on paranoia, and especially when we are, basing our business on a dynamic sort of market. And let's understand what's happened in our environment. It's just not restricted to the stock market or the capital markets. It's about each asset class that one invests in, and the rules associated with each asset class has changed, right? Gone are those days when you could say, chalo, let's invest in real estate or property, and in this many years it will make money. I mean, in Mumbai, real estate is selling 25% lesser than what it was 7-8 years ago, and the government has incentivized the stamp duty to 2% to sell that asset class. It has never happened in the history of that asset class, I would say. Gold, which did not give money, just made money in 2-3 months' time, which didn't make money for a long time. Similarly, if you look at mid and small cap, the last 2-3 months has seen a complete reversal in that entire sort of spectrum. So the point I'm trying to make is, gone are those days when you could make a plan and just forget about it. A good, active distributor, a dynamic distributor, can change or create enough wealth for an investor. And that's rule number one. One is to create dynamic portfolios. Now, rule number two is review that portfolio regularly and unemotionally. If there are scope for rebalancing, rebalance ruthlessly. At the same time, respect markets, respect some of the data that is coming out. I think some of the data that is coming out is throwing out certain realities in front of us. And the sooner we inculcate those realities in our business plan, the more sustainable or future ready we will be. These are great times to be advising investors. There is a need for wealth creation in the country. And I see the MFDs playing an incredible role in the lives of people going forward. There is a reason why we were given the essential needs status during this pandemic. And I'm very happy to say that all of us have risen to that task. And going forward, I think we have been given the social importance that we've been craving for. We were put at par with doctors during the pandemic. And that should be, a good pat on our shoulders on how the country views us going forward.
Great. So, Swarup, one final question. So, what is your business outlook for 2021?
See, I think we are at a very interesting position when it comes to the asset management business. I do believe that the way business was done prior to COVID and the way business will be done post-COVID may not have any correlation with each other. That is how dramatic I feel at this moment, because maybe it's 6-7 months of sitting at home, or call it whatever, little bit overthinking or introspection. But I am a paranoid person when it comes to building business. Somebody tells me that we are 60,000 crores of AUM. I see it as 60,000 crores of redemption, and it's our job to retain that money. So one, I think the old and tested business model of keeping your products intact, that's something which will hold us steady if we are able to keep it intact going forward. That is test number one. But I think at the underlying, the demography, as I said, is changing dramatically. And I have a fear, which I have been spelling. I spelled this out some 3-4 years ago, that the new investor, there is a possibility that the new investor might come to us and say, all your products are extinct. There's a possibility. Because the products that we've been dealing with have been to my generation and my previous generation, that is my father's generation. The next generation life is very different. And let's face it, the next generation life is online. Right? It is, I don't, it is just a matter of, it was a matter of time that the number of demat accounts in the country would have exploded. And that's what happened last year. Right? How they behave is only time will tell. But so to, like I said, I have to take this data into perspective and inculcate that in our business when it comes to the business outlook for next year. We believe we are on the threshold of something special. We believe we can run both the businesses, that is the passive and active, together. And the best thing that happened in COVID was long debt investing. If people say that, we are in a low interest rate regime, I've been hearing this for the last 20 years of my mutual fund sales. Let's face it, there is a lot of money, and everybody knows the amount of money that is stacked up globally at zero or negative interest rates. So we at 5.9 10-year yield today still have some scope for making money. We don't need dramatic changes of interest rates, but there is still some scope when it comes to the next 3-5 years horizon. So that makes long debt investing also good. So we've got asset classes which are capable of creating wealth for us. The choice will be to allocate it carefully and build good investment experience for our partners. Continue to do that. That's the business outlook. And it's going to be tough. It's going to be different because the skills required for the markets going forward are very different to the skills that we had prior to COVID. Is a realization.
Okay, so with that, we have come to an end inside. And thank you so much, all of you, for being with us. Happy New Year.
Wish everybody a very happy New Year. Keep safe and remain healthy.